Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we've got Ben Schuster with us, and Ben is in San Diego with Comfort, and he is raising funds, but he has an interesting journey to working with BlackRock and then coming to Comfort, all because of a connection at a coffee shop. So Ben, it's great to have you. I'd just love to hear this story, how it went all together.
Thanks, Bruce. Yeah, no, I'm happy to be here and happy to have a conversation with you about how I got to Comfort and what we do on the manufactured housing community side, and then probably touch a little bit about my life and backstory.
That'd be great. So you grew up in San Diego.
Born and raised San Diego, so I've lived all over the county. I was a former youth homeless here in San Diego, so while most people just think of it as the beach and La Jolla and Carlsbad, there's other parts of the county. And then after experiencing that, I was fortunate enough to have another family that took me in to their home when I was about 12. I lived with them from 12 until I was 17. Went to college. I went up north, kind of over by you some ways. I went to Chico State, studied finance and economics. And then after that, I went and worked for BlackRock for about 7 years. Before transitioning back down to San Diego, my wife and I, we bought a house down here as a rental property. It was kind of my first time dipping my toes into my own real estate investing journey. And through that process, I met Blake Comfort, who I believe you've had on the show, at a coffee shop. And so we sparked up a conversation. I was really interested in the manufactured housing community space, and we just became friends for about a year. And he convinced me to leave BlackRock. I was on the private equity real estate team at that point in time, which is not easy to get on. So it was a big jump for me, but it was the best decision I ever made. So I moved over in 2023 and now I've been on the team for going on 3 years.
So let's go into that a little bit. So tell me a little bit about what investors are looking for when they come to Comfort. What do they find that they don't find it in other places?
Yeah, they're looking for a stable yield. So they're looking for cash on cash. They're looking for a defensive asset, something that is going to perform regardless of the market cycle. So during up times, down times, they're looking for, like I said, stability, but they're also looking for upside. So a lot of our investors are, I'd say, higher net worth individuals, right? We have a 100K minimum. So generally, if you're writing a check for 100K, you've made some bucks along the way and know a thing or two. And so they're not looking to get rich overnight, but they're looking for stable cash flow and then the preservation of capital over time and growing their capital over time. And so the other piece that our investors are really hyper focused on is tax strategies, as are we. So they're looking for depreciation. So they like, they like that we do cost segregation analysis and pass through the depreciation back on the K1 to them, as well as they don't want us to necessarily just go sell the deal in 5 years and hand them back their cash, because they're smart enough to know that they're going to have recapture taxes. So we do a 1031 exchange strategy. We're kind of a forever hold in the asset class. We hold our deals roughly between 7 to 8 years. But every time we sell, it's Blake's job, which I know you've interviewed Blake, you know him, to go out and then find the up lake property, deferring all capital gains and then just compounding cash flow and growing net worth.
So if I recall from Blake's conversation, there are some special tax depreciation effects you can get from manufactured housing. Am I recalling correctly?
Yes, you are. Yeah. Manufactured housing communities are probably the most advantageous from a tax perspective. And it's really not because of magic, it's just the components of what you are buying. So because you don't own any vertical infrastructure, all the purchase price, minus the land, you can't depreciate land, obviously, is allocated to land improvements, which sit on a 15-year and below depreciation schedule, which is eligible for the bonus or accelerated depreciation. That is part of the big, beautiful bill that was passed on July 4th. And so as an example, let's just use, very high level math. On a $10 million property, roughly $2 million is going to get allocated to land, which you can't depreciate. The remaining $8 million is going to get allocated to the water lines, the sewer lines, the electrical infrastructure, the streets, the concrete pads, the lights, the fencing, the landscaping, the pool. you name it, right? And that all sits 15 years and below. So our investors generally can invest, let's just say $100,000, and on their K1, they'll receive 100 to $120,000 of year one losses. So for folks that can use losses, they're hyper focused on investing with us because they can use those and then defer taxes in other places.
So this obviously sounds very appealing to people in terms of if you're a high net worth person and you've
Yeah.
got income coming in and you need some tax write-offs, this looks very good, I would think.
Yeah, absolutely. And I didn't actually get into the space I don't love this asset class because of that sole reason. I spend a lot of my time talking about that. As you can imagine, I talk to hundreds and thousands of investors every year. But not only is it really great for the tax piece of it for high net worth, it also pays great current yields. And the rent growth, is real in our space. A lot of these deals that we're buying have been mismanaged by mom and pops, and they don't really understand where current market rents are. And there's a lot of deferred maintenance. And so there's a lot of certainty on the rent growth side. And then, there's only two ways to make money in real estate: it's rent growth and cap rate compression. And on the cap rate side, it's the only asset class I've ever seen, and I've worked on a lot of different asset classes where you have an ever-growing demand in the terms of people looking for affordable housing solutions, but you have a shrinking supply in the amount of mobile home parks that are taking out of the stock, the supply every year due to repurpose or redevelopment. So it's a fascinating asset class. It's really interesting.
That was the one part that really did interest me, was the fact that communities are not very proactive about having manufactured housing in their communities, which sort of shocked me in that it's such a easy solution to housing that you'd think more communities would be proactive in this area, but apparently not.
I agree. It's unfortunate, to say the least. I think it's really the solution to the affordability crisis. I think Blake probably talked about it, and I won't go into too much detail on it, but you can deliver homes in the manufactured housing space at about $50 per square foot, which is uncomparable to any site built community or affordable community that you could build. And so the affordability is real and it's built in to the product. Put differently, it's not subsidized. It's the most affordable non-subsidized housing in the United States, and there's not a close second.
So I'm curious, you've been in this business for a while. So what marketing strategy are you using for obtaining investors?
Yeah, it's education. It's repeat and referral. It's doing what you say to investors. I get out and I meet a lot of investors. I try to do a lot of what I do is educate. I'm just passionate about these deals. I'm passionate about the asset class. The returns are real. The depreciation is real. And so what I do is just, have that passion, that education on the space come through, whether that be in my newsletters or my conversations with people, and really just try to get the word out there as much as possible. I'm really passionate about people preserving and making money. Like I said in the beginning, I was a former youth homeless. I've been in times where my mom bought a house in '05 that she couldn't afford, and the realtor was giving her a flat screen TV, and she got an adjustable rate mortgage, and times were great, and then they were bad again.
Right.
The sheriff's at the door, we're getting evicted, and my mom really relapsed. So I really am passionate about people preserving and making wealth, whether that's with us or with someone else. And so I just really like good deals that make sense. And I think real estate is a fantastic asset class as long as you don't get ahead of yourself and over your skis and financially engineer the returns and put yourself in a pinch, and do well by your residents, right? And you drive value there, which then drives value back to your investors in the form of increased rents or increased appreciation through a lower cap rate because it's a valuable deal. It's a sought after deal.
Yeah, no, I mean, this whole asset class to me is fantastic. And I just, unfortunately, it is not sexy or not thought to be sexy. And so I think a lot of people may shy away from it. But quite frankly, I think it's one of the best things out there. And your Comfort's performance in this area seems to reflect that. So I think it's a great investment for people that are looking.
Thank you. Yeah, I appreciate that. We pride ourselves on the the value that we bring to our investors and our residents. And we have a lot of fun doing it. Like, I don't wake up, you know, I don't wake up anymore thinking like, oh man, I got to drive to go into the office and work. It's like I'm fired up. I love what we do. I love chasing deals. I love improving and seeing value through the clubhouse renovations or new roads or installing new homes, hearing the stories of our residents when we cut the ribbon to open up these brand new clubhouses that are beautiful and they start crying. And it's really cool. And I love talking to my investors and, they become first, it's like, their acquaintances, and then they become investors, and they become long-term dear friends, and so it's really cool. So the relationship side of real estate is really unique, and it is a relationship business. So that's really fun to continue to foster that and grow that.
So I'm curious, it sounds like you actually are getting involved in the actual buying of new locations.
Yes, yeah. So we've been historically been doing it for 16 years. First deal we bought was in Colorado. It was, just this is how you grow, right? It was a $600,000 deal. We raised $200,000. It was Blake and Jen at the time. $200,000 from some friends and family. They did everything themselves. To today, we're on track to buy about $100 million worth of real estate this year, raising $50 million of equity, all from, high net worth accredited investors, people that we know. We don't do any advertisement, any marketing. And so it takes 16 years to build a 16-year track record. And you got to get a lot of bumps and bruises along the way to really understand your buy box. And so we really are focusing now on Dallas, Fort Worth. We like very strong growing MSAs where you're seeing strong population growth as well as job and wage growth, because that to me, and this isn't a science, but that to me means that you're going to have future rent growth, especially on the affordable side, because everything that's getting built now and today, whether it's SFR or new apartments or built for sale communities, that's none of that's affordable because it's not. It doesn't make economic sense to build affordable because of how expensive it is to build. So you are constantly looking for markets where you're seeing growth, where affordability is very low, because those are the types of markets where we're going to have very stable and high occupancy. You're not going to have any problem if you have turnovers, being able to sell homes very quickly, as well as you're going to see future rent growth.
One of the fascinating things that Blake talked about is that there's very low eviction rate in manufactured housing communities, which, think about it.
Yeah, you want to hear an interesting stat. So I used to run Class A 300 unit plus apartments all on the West Coast. My turnover rate there was roughly about 25 to 50% per year, right?
Wow. Whoa, really?
Normal on a rent roll, yeah. And so the normal tenure on a large apartment complex is roughly 2 years. Someone stays,
Whoa.
And so in MHC it's 14 years.
Wow.
And so it makes sense. It makes sense, right?
Yeah, right. People get there, they're happy, they don't want to move, they have low rents.
And they own the homes. So it's their most valuable asset that they own, right? So they pay us, people might not know this if you're not familiar with the asset class, but it's a quasi build for sell / build for rent community. The tenants physically own their homes, and then they pay us a space or a lot rent to have their home in our communities, be able to use the infrastructure hookups, and then use all of the amenities. And so in terms of where you fall on the capital stack in terms of priority, or like, let's call it the bill stack, right? Everyone has bills every month. We are at the top of that priority, because if you don't pay your space rent, effectively you need to do like one of three things. One, you need to move your home, which is expensive, $10,000 to $15,000 to move the home. Oh. You need to sell the home, which you have to pay space rent all during that time of you marketing and selling that home, or you have to abandon that home, and or we will buy it from you. Now, we're very conscientious and we're really good stewards to our residents. We're not predatory in any way. We really try to help people out that fall on hard times. But I say that to kind of give you why this is a defensive asset class for investors to think about.
Yeah, no, I mean, in terms of your bill stack, if you're at the top of the bill stack, well, the typical rental rate that people look at is what, 1/3 of your income should go to
Yeah,
rent?
to rent, right? Generally speaking. I think
So,
right now, because of affordability so low, it's like closer to like 40, 50%. I mean, affordability right now is at the lowest level that it's ever been. It's kind of frightening to look at from when you start to look at where rents are, where mortgage rates are, and where asset prices are.
so just curious, if you take say the mortgage rate on your manufactured house plus the rental rate, does that typically go up to 40%?
It's a good question. It depends. There's like affordability indexes that you could look at to kind of gauge that. And it's going to depend market by market. But I'll put it to you differently. Space rent or our rent is generally 50% of comparable B or C class apartments per square foot. Is that a helpful context?
Yeah, that's interesting. Yeah, and that was sort of what I was driving at, that cost, the rental rate that you're receiving is a smaller fraction of the total income picture for that particular tenant. So,
Yes.
uh,
Yes.
so in theory, it should make it easier for them to pay that amount.
Yeah. And then from a nominal standpoint, as well, let's just say your space rent is $50 or $500, excuse me. If you raise your rents, call it 5%, you're at 525, right?
Right, right,
So and then so percentage wise, because all real estate's value is derived on a discounted cash flow. So 5% year over year rent growth that's pretty good. People would be like, that sounds aggressive, right? But it's only $25. And I already ran through what
right,
they would have to do if they couldn't be able to come up with $25. It's basically like going to McDonald's now for two people. Um, but then you carry that forward over 10 years across 400 sites, and it's meaningful returns on the back end, especially given
right,
the demand for these assets and where cap rates trade at because the institutions love these asset classes as well, and they pay a premium for them because they know the certainty on the income stream. But if that was a $2,000 apartment rent, right, and then you're talking $100, if my
right.
math's right, you're talking $100.
Yeah,
And then if the apartment across the street is getting developed and it has a nicer gym or what have it, and they're giving you 1 month free rent because of what's going on in apartments right now, you might say, oh, you know what? I got a flat screen TV and a couch and a bed. Why don't I just pick up and go over there for 2,000 to get 1 month free rent? It's really like I'm paying, $1,700 a month for the next year, and I'm going to move out, in another year after that as well. So that's why the certainty, not only on the rent growth, is more real, just that nominal, because you're coming off a smaller nominal base, but then also the friction it takes to actually make a decision to move.
well, it also sounds like you can increase rates at a little higher percentage than perhaps other asset classes.
You can, yeah, and you want to be careful, right? But yes, in theory, you can.
Yeah, which I'm sure the investors all appreciate. And certainly if you're buying a mom and pop location and they haven't increased rents for a while, you can make that all work together too.
You can, our opinion on this is that you need to, if you're going to drive rents, right? Like, let's just use a hypothetical example. Let's say with our $500, let's assume $500 is the market rent in a
Yeah,
specific market. Say you go in and buy a deal that's 100% occupied, that's $250 uh, per pad.
yeah,
Now you can go in there, assuming you're in the states that we are in the metros, and you could double the rents overnight. We
oh,
don't like to do that, right? Because to us, it's not a you're not a you it's not the way that you should manage a property and
right,
operate a property. And so the way that we look at it is like we know that we have built in or embedded rent growth, which I feel really good at. So then I'll look at my in place cap rate and then I'll gross up and say it's at 500, and like what's my yield on cost or my mark to market cap rate. Now that spread to me is very important because if I look at my mark to market cap rate and I'm getting a really good spread risk premium over my 10-year treasury or whatever your risk free
right.
rate is that really is the magic. And then now how do you get there? We generally like to get there by year 3 or 4. And the way that we do it is that We will go in, we'll put an initial rent bump. Let's say if it's 250, and I'm giving away a little bit of my secret sauce here, but it's okay. It's a lot easier to say, it's a lot harder to do and do it well. So say it's 250, maybe we'll go in there and we'll do like $100 or $50 or $75 rent increase. Right. And
Yeah.
then it's basically a letter saying, hey, look, you have the cheapest seats in town. And a lot of the times the reason why it's so low rent is because the landlord has a ton of deferred maintenance and they haven't put any improvements into the park. So it's not like it's a great park to begin with.
Right.
And then on the second year, what we do is right after we implement that, we start our capital improvement project. So new roads, all new clubhouse, completely redesign, new landscapes, new playgrounds for the kiddos, places for the kids to go do homework, pool tables, just beautiful amenity package. And then you put in the next rent bump and then you're just at market, right? But what you did is you drove a ton of value back to the residents. And what that does is that actually increases the home values of those residents. So you're giving them equity effectively because they own their homes, right? It's no different than a neighborhood. If you have a home in a neighborhood and it's a really crappy neighborhood and everyone has trash everywhere and there's crime, that home is going to trade very less than a neighborhood maybe a couple of blocks over that's really nice. Everyone takes care of their yards, it's well manicured, there's street lights and what have you. And so there's no different than an MHC. What's really cool about MHC is that we're in control over that neighborhood. And so we can enforce our rules, put in cleanup initiatives. So I could talk a lot about this asset class. I'm passionate. I don't need to pitch my own book, but it's so interesting. So like what we do going into a community as well is that we'll bring huge rollout dumpsters and we'll do cleanup campaigns and we'll run a competition of the best yard and the most improved yard to give like
Oh, wow.
$1,000 Amazon gift cards for the
Wow.
winners. And we'll leave those rollout dumpsters. We say, throw out your trash, whether it's inside your house, outside your house. But after, the 1 month after we do this grace period, then we're going to implement our rules and enforcement. You can't have a broken washer and dryer or a broken down car in your driveway or something like that. The car, I mean, not in their driveway, but like in their lawn, right?
Yeah.
And so we'll have them clean up. You start to enforce that ownership, that pride of ownership to the
Right.
residents, and it's amazing what happens to the community over time.
Wow. So then throw in all the depreciation that you get, and I suppose you get depreciation on the capital improvements, all that kind
Yeah,
of adds up for the investors.
exactly. Yeah. You could either, with the capex, you could either expense those or have them in the form of depreciation. So it all flows back through the K1.
That is fantastic. Well, I think we could talk for another couple days about this, but I want to readdress. We may have to come back and have you and Blake on at the same time in like 3 months to kind of go through this and see how the market is changing. Although, quite frankly, MHC, it sounds like the market doesn't change very much.
Uh, it does and it doesn't, right? I mean, just like when interest rates went up, cap rates went up as well. They didn't go up as much as in multifamily or other commercial real estate asset classes, primarily from a function of what was happening on the deliverables. There was, 40-year high of construction and deliverables and apartments. You don't have that in MH because there's no new supply that's coming online. And then the second component about apartments that you experience is that floating rate debt was just prevalent. It was everywhere. So then in 2021, everyone was trying to get deals to pencil. There were three caps. They were putting on floating rate debt to then be able to offer a return to investors that they could actually pitch and go raise money on. And then the Fed increased rates faster than any time in history. And now you're starting to see those assets trade at significant discounts. So it does change. I mean, when you're MHC geek like Blake and I, like, yeah, we see changes, but it's minimal compared to the amount of change that's happened in the broader commercial real estate landscape.
Well, you probably saw a lot of that at BlackRock, I'm sure.
Yeah, we did. I don't think, even the smartest operators were not immune to what happened. I'm just glad that we didn't take on, any floaters. I think we took on one floater at the time, but we were able to grow out of it. And so there wasn't any issues there. We have no distress, which is really great to hear. It helps because this is a good buying opportunity right now. We're seeing some of the best deal flow I've seen since I've been here. And it's really a component of people have pain in their portfolio, not from their MH stuff, but from their other things. And so it's been pencils down from a lot of the institutions. And so we get to come in and clean up and just buy really great deals off market. And our brand and our reputation and really just being a handshake company and doing what we're saying we're going to do is carrying us through this cycle. And so I'm really excited about the opportunities that we have this year and for the next couple of years. I see it as a moment in time for some of the best deal flow we might see.
Wow. Well, it sounds like you've got a lot of dry powder to work with right now.
Yeah, you could always use more, but yes, we're very blessed and thankful. We have some amazing investors that believe in us and in these deals just as much as we believe in these deals.
All right. So for all of you investors out there that want to get into this class, how do they get a hold of you, Ben?
Yeah, as you can tell, I love to talk about this asset class and what we do. So they can reach out to me on LinkedIn, Benjamin Schuster. Should be able to find me. And then you can go to our website as well, comfortcapital.com. And I believe there's a button there where you can get in touch with me.
That's great. All right. Well, I'm going to come back in 3 months and have both of you on, and we're going to talk again about what's happening out there.
Let's do it. You might not be able to get a word in with both Blake and I.
That could be true, but that's okay. We'll deal with it at the time.
Thanks, right. Bruce. I appreciate it.
Talk to you soon.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.